Hi, I'm Michael Yardney, and at any given time there could be up to 350,000 properties for sale in Australia. But in my mind, less than 5% are what I'd call investment grade. So today I'd like to have a look at the type of properties that investors should not buy. First of all, I'd like to look at the sort of properties the banks don't like. You see, there are certain properties that they're not going to lend as much on. They're going to lend you a lower loan to value ratio, meaning you've got to fork out a bigger deposit. More importantly, if the banks are wary of them, rather than thinking you know better, take it as a warning. Consider maybe looking elsewhere. In general, banks restrict lending to properties which appeal to a limited resale or a limited tenant market, including serviced apartments. You see, these carry a lot more risk than buying ordinary apartments, as you're relying on an operator to get it right or on the tourism or business markets to remain strong. These properties also have a limited resale market. You see, only investors tend to buy them. This means you're cutting out 70% of potential purchasers. They've also got a limited lending market and often have expensive ongoing management. Banks also don't like lending as much to Department of Defence housing accommodation. Of course, these properties come with certain long leases and ongoing maintenance that they look after for you, but they've again got a limited resale market and hefty management charges. Banks also prefer apartments to comprise at least 50 square metres. They're wanting bigger apartments rather than small ones. However, with lifestyle changing a little bit recently, some banks are prepared to lend up to 40 square metres in size, but they don't like studio apartments or student accommodation because these have a particularly restricted market because of their size. The banks also don't like lending against large off-the-plan developments. They see that as a concentration risk, and therefore they restrict how many apartments they're going to lend on some of these larger complexes. Of course, there's lots of other issues with off-the-plan properties that would make me wary of them. Now, there's other sort of properties I'd avoid as well. I avoid out-of-place properties. You see, I buy properties that would fit into the overall character of the neighbourhood. While I love terrace houses, if the property happens to be the only terrace in a street full of bungalows, I'd look elsewhere. I'd like to buy a property consistent with the streetscape. I also avoid the wrong locations in the street. Even some of the great streets have an unattractive mix of properties that are at the wrong end of the street, maybe too close to the shops, too close to the main road. So buying the right property in the right section of the correct street. Also avoid properties with encumbrances on their title, covenants, easements, overlays that could restrict you in the future. And banks restrict lending on apartments in some of the older forms of title, such as company share titles or strata titles. And please avoid properties with body corporate problems. Carefully peruse the minutes of the last owners corporation meeting. Are there any building issues or maybe excessive expenses planned? Have they set aside a sinking fund for repairs or refurbishment? And avoid properties where there's car parking issues. It's always going to limit apartments' appeal for tenants, to homeowners, to future purchasers if there's no car spot. And avoid properties in the wrong position in the blocks of apartments too. You know, those ones that overlook the car park or situated near the waste bins. And I definitely would avoid main roads and secondary locations. Not sure people live everywhere, but when the market slows down, secondary properties are harder to sell and they fall in value first. I also avoid rental guarantee properties. You see, the cost of the rental guarantee, which is usually inflated to make the property investment look better, is added to the purchase price by the developer. They justify their initial high price by doing that. The problem is that you're paying for that. It's inflated in the price, and it's not uncommon when the rental guarantee finishes that the rent drops and leaves you with a hole. Another sort of property to avoid would be holiday apartments or holiday homes. Now, I'm not saying don't get a getaway if you can afford it. What I'm saying is don't pretend you're buying an investment, because you likely end up with an asset that on the one hand isn't meeting your lifestyle dreams and on the other doesn't really deliver your financial objectives. And of course, if you've been following my blogs by now, you'd know I'd be saying avoid mining towns, because there's not a big market depth from owner-occupiers. Those areas are investor-driven and very volatile. And over the years, I've always suggested avoiding NRAS properties, but that's almost out of the way now too, because the government's stopped the NRAS scheme. But avoid any type of specialised property. The lesson from all this, I guess, is that if you want your property portfolio to outperform, You need to own the type of property that will appeal to a wide demographic of owner-occupiers, who in general make up the bulk of purchasers. They tend to buy more emotionally, they tend to pay higher prices, and they push up properties around yours that look like yours because they then push up the value of your property. To top it off, these are the sort of properties that the banks are willing to lend 80, 90, sometimes 95% on. Now that's interesting, isn't it? If you'd like some help finding those type of properties, why not get the team at Metropole on your side, levelling the playing field. With offices in Melbourne, Sydney, Brisbane and affiliates in Perth, we've got access to all the properties on the market. But as we have no properties for sale, our suggestions, our advice is independent and unbiased. Why don't you contact us and we'll do an initial free strategy session with you or review your existing portfolio.